Your credit score is one of those numbers that controls your life without you really understanding what it does or even how it gets calculated in the first place. It sits somewhere between 0 and 900, and depending on where it lands, it can determine whether you get a loan, what interest rate you'll pay, whether you get an apartment, and sometimes even whether you get a job. You can't see it, you can't touch it, but banks, landlords, employers, and increasingly insurance companies all care deeply about it. And the weird part is, most people have absolutely no idea how it works or what goes into it. They just know it's important and that if it goes down, bad things happen. Yet despite how much power this number has over your financial life, the systems that create it are surprisingly opaque and deliberately confusing. So, what exactly is a credit score, and where does it actually come from? How is it calculated? And more importantly, what can you actually do about it if yours has gone down? These are the kinds of questions we're going to unpack today. A credit score is essentially a 3-digit number meant to predict the likelihood that you'll pay back a loan on time. Credit scoring has been around since the 1950s, but it became mainstream in the 1980s when credit card companies needed a standardized way to assess borrowers. Before that, banks knew you personally and made gut calls. The most famous system is called FICO, which stands for Fair, Isaac and Company, and that's what most lenders use today. FICO scores range from 300 to 850, and the higher your number, the better. A score above 670 is generally considered good, 740 to 799 is very good, and above 800 is excellent. Below 669 is considered fair or poor, and below 580 you're basically locked out of most traditional lending. Now here's where it gets interesting. Your FICO score is calculated using 5 categories of information. The biggest factor, making up 35% of your score, is your payment history. This is simply whether you've paid bills on time. If you miss payments, that's bad. Late payments stay on your report for 7 years, and the more recent they are, the more they hurt you. The next category is credit utilization, which makes up 30% of your score. This is the amount of credit you're using compared to what's available. If you have a $10,000 card limit and carry a $5,000 balance, that's 50% utilization. Credit agencies like to see this below 30%, ideally below 10%. The logic is that high utilization suggests you're a risky borrower. So even if you pay your balance in full every month, having a high balance on your statement date hurts your score. The third factor is the length of your credit history, and it makes up 15% of your score. This is the average age of all your credit accounts. If you've had a credit card for 20 years, that's great for your score. If you just opened your first credit account last month, that's not so great. The logic is that having a longer history means we have more data to predict your behavior, which makes sense from a statistical standpoint. This is actually one of the most frustrating parts of the credit score system, because young people and people who are just starting to build credit are basically punished for not having had credit for a long time already. There's no way around this one. You just have to wait. The fourth factor is credit mix, and it makes up 10% of your score. This is basically how many different types of credit you have. Having a mortgage, a car loan, and a credit card is better than just having 3 credit cards. The idea is that if you can handle different types of credit responsibly, you're less risky. And finally, the last 10% comes from new credit inquiries and new accounts. Every time you apply for a new credit card or loan, that counts as an inquiry, and it slightly dings your score. Opening new accounts also dings it a little bit. The logic here is that people who are desperately seeking new credit are riskier than people who already have what they need. Now, the reason credit scores matter so much is because they've essentially become the password to financial opportunity. When you want to buy a house, the bank isn't going to look at your character or your life story. They're going to look at your credit score and use that to decide not just whether to lend you money, but at what interest rate. The difference between getting a mortgage at 6% versus 7% because of your credit score doesn't sound like much. But over 30 years on a $300,000 loan, you're paying tens of thousands of dollars extra. That's the power of these 3 digits. Getting a car loan, renting an apartment, even getting a job, all of these things now depend on credit scores. A lot of employers check credit scores before hiring because they think it's a proxy for reliability and responsibility. Insurance companies use credit scores to set rates. In some states, a bad credit score can actually make your insurance premiums significantly higher. It's this weird feedback loop where if you're poor or struggling financially, credit scores make everything more expensive for you. If you already have money and good credit, everything is cheap. It's a system that basically amplifies existing inequality. But here's where people get really confused about credit scores. There are actually a bunch of myths and misconceptions about how they work. The first big one is that checking your own credit score hurts it. This is completely false. Checking your own credit score is what's called a soft inquiry, and it doesn't affect your score at all. Hard inquiries, which is when a lender or creditor checks your score as part of an application, those do ding your score a little bit. But looking at your own score, that's fine. Do it as much as you want. Another myth is that paying cash is better than building credit. This is actually kind of true and kind of false at the same time. If you pay everything in cash, you never build a credit history, which means when you actually need credit for something like a house, you'll have a hard time getting it. On the other hand, if you go into debt trying to build credit, that's obviously not a good strategy either. The sweet spot is using credit responsibly. Open a credit card, buy things on it, and pay it off in full every month. You build credit history without paying interest. Some people also think that having no debt is the best for your credit score. Again, this is kind of false. No debt means no credit history, which actually hurts your score. Lenders want to see that you can handle debt responsibly. They also think that your income affects your credit score. It doesn't. Your credit score is purely about how you've managed credit and debt, not about how much money you make. Improving a credit score is simultaneously easier and harder than people think. It's easier because the path is pretty straightforward. You need to pay your bills on time, keep your credit utilization low, and don't close old accounts even if you don't use them anymore. That's basically it. The hard part is if you've already messed up. If you've got late payments or collections on your report, those take 7 years to fall off. There's no magic way to make them disappear sooner. Some companies advertise credit repair services that claim they can clean up your credit, and honestly, most of these are just scams. If there's accurate negative information on your credit report, nobody can legally remove it before the time period expires. You just have to wait and build good habits in the meantime. One thing you can do is dispute inaccurate information on your credit report. You're entitled to a free copy of your credit report from each of the 3 major credit bureaus every year, and you should definitely check it for errors. If there's something wrong, you can dispute it, and they have to investigate and remove it if it's not accurate. Another strategy is becoming an authorized user on someone else's credit card account, preferably someone with good credit and a long history. Their positive payment history can help boost your score. But honestly, the fastest way to improve your score is just time and good behavior. Pay everything on time, keep your balances low, and wait. Now, here's the thing that's kind of controversial. The entire credit score system is actually built on a specific way of thinking about risk and debt that might be starting to change. For most of history, credit was about relationships and reputation. You knew your lender and they knew you. Then it became about statistical prediction, which is what FICO scores do. But now we're entering a new era where artificial intelligence and alternative data might reshape how credit is assessed. Some companies are now looking at things like your payment history for utilities, rent payments, even your smartphone payment history to assess creditworthiness. The idea is that this paints a more complete picture than just traditional credit history. Some developing countries are basically skipping the traditional credit score system entirely and building alternative systems from the start. There's also increasing concern that credit scores are perpetuating discrimination and inequality. Studies have shown that people of colour have lower average credit scores, not necessarily because they're worse with money, but because of systemic factors like lower average wealth, limited access to traditional banking, and historical discrimination in lending. So there's this ongoing debate about whether credit scores should exist at all or whether they should be reformed entirely. And that's actually a pretty reasonable debate to be having. Because a system where your access to housing and jobs depends on a number that was invented in the 1950s and you barely understand is probably not the best system we could come up with in the year 2025. So yeah, your credit score matters way more than it probably should. And the sad part is that most people don't really know how it works or how to fix it when it goes wrong. It's one of those systems that's so fundamental to modern finance that nobody really questions it anymore. But if you're starting to pay attention to yours, or wondering whether you can improve it, the basic strategy is the same as everything else in personal finance. Pay your bills on time, don't spend money you don't have, and be patient. That's it. Thanks for watching, mate. Bye.